After studying this module, you shall be able to learn about responsibility centers, objectives of responsibility centers, measure of divisional performances, various determinants of measurement, techniques of measurement, evaluate measurement techniques. Introduction. A responsibility center is a part of company for which a manager has ability and responsibility. The company's complete organization chart is a logical source for formative responsibility centers. The most frequent responsibility centers are the departments within a company. When the manager of a responsibility center can control only costs, the responsibility center is referred to as a cost center. If a manager can control both costs and revenue, the responsibility center is known as a profit center. If a manager has power and responsibility for costs, revenues, and investments, the responsibility center is referred to as an investment center. Responsibility centers are identifiable segments within a company for which individual managers have an established authority and accountability. Responsibility centers define accurately what assets and activities each manager is responsible for. How to classify any given responsibility depends on which aspects of the business the department has authority over. Management prepare a responsibility report to evaluate the performance of each responsibility center. This report compares the responsibility center's budgeted performance with its actual performance, measuring and interpreting individual variances. Responsibility reports include only controllable costs so that managers are not responsible for activities they have no control over. Using a flexible budget is helpful for preparing a responsibility report. Objectives of responsibility center. The responsibility center is a difficult structure which can settle its own multiple objectives according to the strategy of the business it is part of. As devise its own planned activities satisfying the needs of the clients, respecting the delivery deadlines, promoting creativity, etc. Optimizing the method of using the source as for the enhancement of the center's global presentation and that of the responsibility center. Establishing the systems of evaluation and control of performance, financial, operational, personnel, management, marketing, etc. Establishing valid procedures of devising the expense budgets corresponding to the responsibility center with the possibility of integrating and emphasizing within the general budget of the entity, unraveling and allotting expenses for fixed and variable costs. Simplifying the system of emphasis, the procedure for communication, reporting and collaboration, amplifying the operating speed by installing information procedures, introducing and perfect procedures for financial accountancy balance sheet, increasing the capacity to regulate production to the requirements of the clients in terms of quality, changing the employees' materiality in the sense of increasing awareness of the need for them to be active, participatory, and efficient. Measures of divisional performance. Performance measurement criteria must be clear. It will help the divisional managers to decide on which items they should concentrate their efforts and resources. The targets or objectives contained in the performance measures should be attainable with reasonable efforts. If targets are too high, they will undermine the effectiveness of divisional control system. Target should be established jointly by the performance manager and coordinating manager to promote acceptance of organizational goals by the responsibility center managers. Divisional performance measures are not confined to quantitative measurements. Measures should be selected which can help in making a judgment of the level of activity performance by a responsibility center. Performance measures selected should help in making a realistic assessment of the effectiveness and efficiency of a responsibility center. Efficiency thus focuses on the relationship of output to input. Effectiveness implies contribution to the achievement of ultimate goals of the responsibility center, division, or department. Performance measures should be competent enough to evaluate both short-term and long-term performance of a division. Multiple measures enhances goal congruence and reduces sub-optimization. Multiple measures or goals include productivity, profitability, human resource development, employee attitude, market share, customer relations, and contribution to social responsibility. It is argued that too many goals sometimes may confuse the divisional managers. Adequate as well as manageable measures say 4 to 5 can be preferably used. Various determinants and technique of measurement. Variance analysis. Variance analysis may be cost variance and revenue variance analysis. Presentation of a cost center can be evaluating using cost variance analysis, that is, by comparing the actual costs with the standard costs. Any variance between the actual cost and the standard cost require corrective action by the management. On the measure of performance in terms of incurrence of cost, attempts are made to reduce the costs of cost center. Measuring the presentation of cost center only in terms of cost incurred without relating to benefits achieving by the center is not measured fair by many companies. Revenue variance study can be used to evaluate the presentation of revenue center. If revenues actual sale are different from budgeted sales, they become the primary focus of management attention. While evaluating the performance of a revenue center, costs incurred are not used as a measure. Division contribution margin. Division contribution margin is defined as the total division revenue less the direct costs of the division. Measures of performance emphasizes the contribution of each division to overall company profits. In this measure, all revenues and costs traceable to the division are included and all common indirect costs of the company are excluded. The direct contribution margin is the most useful profit measure for comparing divisional performance, for making resources allocation decisions, and for overall corporate planning and policy decisions. Top management of the business often use the direct payment market to decide in which divisions other investments should be made, and in this decision will certainly prefer those divisions which are giving most contribution margin. The contribution margin analysis can also be used to decide the discontinuance of a division or a certain operation. If a specific division provides a contribution margin, the division should not be eliminated but retained, although the allotment of indirect cost result in a net loss for that allotment. Division net profit. The division net profit is the most proper profit determined for evaluation of a division's performance. This analysis can be used to judge the presentation of a profit center, as both costs and revenue data measured in financial terms are available. Division net profit is obtained after considering related revenues, direct costs, and a part of indirect cost incurred for the benefit of the division. The division net profit standard is useful in understanding that a division manager becomes aware of the full costs incurred for the entire company and allocated full cost to the specific division. Measuring the presentation of a profit division, it is better to use a measure of divisional revenue less divisional costs and a divisional revenue less divisional controllable cost should be used to measure the performance of division manager. If the presentation of the manager is being assessed, then it would seem sensible to base that assessment that are controllable by him. Return on investment. It expresses divisional profit as a percentage of the firm's investment in the division and is similar to widely accepted return on capital employed measure used in the external analysis and interpretation of accounts. ROI is equal to divisional profit divided by divisional investment. ROI is equal to net profit divided by sales multiplied by sales divided by investment. ROI is equal to net profit margin multiplied by asset turnover. The ROI ratio can be divided into other ratios such as net profit margin and the asset turnover. The net profit margin is the result of firm's pricing policy and its cost control. It is a measure of the relationship among sales, expenses, volume, and profit. The assets turnover shows the amount of sales generated by the assets available and whether a division has over or underutilized its assets. ROI can be increased by any of the following actions, all other factors being held constant. Number 1, an increase in sales price or sales volume. 2, a decrease in operating costs, fixed or variable. 3, a reduction in divisional investment. Residual income. Residual income can be defined as the net income of a division less the imputed capital charge on the asset used by the division. The capital charge is the minimum acceptable rate of the return and is calculated by applying this required or target rate of return to the division's investment base. RI, divisional profit minus percentage of capital charge multiplied by divisional investment. It avoids suboptimal decision as investment are not rejected merely because they lower the divisional manager's ROI. It maximizes growth of the company and increase shareholders' wealth by accepting opportunities which earn a rate of return in excess of the cost of capital. The cost of capital charge on divisional investment ensures that divisional managers are aware of the opportunity cost of funds. Charging each division with the company's cost of capital ensures that decisions taken by different divisions are compatible with the interests of the organization as a whole. Economic value added, EVA. Economic value added can be used for evaluating the performance of a division or segments. Economic value added is generated only if after tax operating income exceeds the cost of investing the capital. EVA is equal to after tax operating income minus weighted average cost of capital multiplied by total capital employed. To improve EVA, managers must earn more after tax operating income with the same capital, use less capital to earn the same after tax operating income, or invest capital in high return projects. If EVA is positive, the company is creating wealth. If EVA is negative, the company is destroying wealth. Evaluate measurement technique. A distinction is or should be made while measuring the presentation of a division and that of evaluate a division manager's presentation while using ROI and RI tools. It is advisable to discriminate between the measure of a division's performance and that of a division's manager. Return on investment and residual income give clues to where an organization might be wise to raise, maintain investment and other things being equal, higher ROI and RI are desirable. Thus, the evaluation of a manager is not identical to the evaluation of the cost, revenue, profit or investment division. Budgets and targets are useful tools for assessing the performance of division managers when managers participate and commit themselves to meeting budgeted goals or targets. Comparing among different divisions within a business enterprise can be made, and subsequently divisions can be ranked in terms of relative profitability. Comparing current performance of a division with the historical performances of the same division is a preferable tool. Comparing division consequences with averages can be useful because differences among divisions resulting from differences in industry do not influence the comparison. Let us summarize. A responsibility center is a part of a company for which a manager has authority and responsibility. The company's detailed organization chart is a logical basis for formatting responsibility centers. The most common responsibility centers are the departments within a company. When the manager of a responsibility center can control only costs, the responsibility center is referred to as a cost center. If an administrator can control both costs and revenues, the responsibility center is known as a profit center. Devising its own involuntary activities, satisfying the needs of the clients, respecting the delivery deadlines, promoting creativity, etc. Optimizing the way of using the resource as for the improvement of the center's global performance and that of the responsibility center. Establishing the systems of evaluation and control of performance, financial, operational, personnel, management, marketing, etc. Performance measurement criteria must be clear. It will help the divisional managers to decide on which items they should concentrate their efforts and resources. The targets or objectives contained in the performance measures should be attainable with reasonable efforts. Variance analysis may be cost variance and revenue variance analysis. Performance of a cost center can be evaluated using cost variance analysis, that is, by comparing the actual costs with the standard costs. Division contribution margin is defined as the total division revenue less the direct costs of the division. Measures of performance emphasizes the contribution of each division to overall company profit. The division net profit is the most suitable profit measure for evaluation of a division's performance. This analysis can be used to judge the performance of a profit center as both cost and revenue data measured in financial terms are available. It expresses divisional profits as a percentage of the firm's investment in the division, and it's similar to widely accepted return on capital employed. Measures used in the external analysis and interpretation of accounts. ROI is equal to divisional profit divided by divisional investment. Return of investment is equal to net profit divided by sales into sales or investment. ROI is equal to net profit margin into assets turnover. Residual income can be defined as the net income of a division less the imputed capital charge on the asset used by the division. The capital charge is to minimize satisfactory rate of return and is calculated by applying this required rate of return to the division's investment base. Residual income is equal to divisional profit minus percent capital charge multiplied by divisional investment. Economic value added can be used for evaluating the performance of a division or segment. Economic value added is generated only if after tax operating income exceeds the cost of investing the capital. Economic value added after tax operating income minus weighted average cost of capital multiplied by total capital employed. Most often, a distinction should be made while measuring the presentation of a division and that of evaluating a division manager's presentation while using return on investment and residual income tools. It is advisable to distinguish between the measure of a division's presentation and that of a divisions manager.